The Bay Area real estate market has been coming back to life in 2026. Homes are selling, apartments are leasing, office tenants are signing leases, and capital is still moving, albeit more cautiously than before. However, the recovery has been neither broad nor evenly distributed. The more interesting story right now is that different parts of the market are recovering at very different speeds. This is SignalPoints for the week of June 7, 2026. I'm Travis Zeiler. Here are 5 current signals indicating what to expect next in Bay Area real estate. Starting with number 1, San Francisco's housing market is showing real momentum again. Recent Redfin data shows that the median sale price in San Francisco is up 15% year over year, with homes selling in about 2 weeks on average. At the same time, recent reporting has pointed to AI wealth driving intense competition in the upper end of the market, especially for scarce single-family homes. But this is not a simple everything is booming story. The strength appears to be concentrated in certain neighborhoods, price points, and buyer profiles. That matters because it reinforces a broader theme we keep seeing across the Bay Area, that the recovery is indeed happening, but it's not evenly distributed. Number 2, investor and entity buying is becoming a bigger part of the conversation. Approximately 28% of homes sold in the San Francisco metro area during the first quarter of 2026 were purchased by entities such as LLCs, corporations, and trusts, according to a recent Redfin analysis. That was the highest share reported since 2000. At first glance, that sounds like large investors moving aggressively back into the market, but the reality may be more nuanced. Some of this activity likely reflects individuals using trusts and LLCs for privacy, estate planning, or asset protection, particularly among high net worth buyers. So the signal here is not simply that investors are taking over the market, it's that San Francisco residential real estate is becoming more financially complex, more wealth-driven, and increasingly tied to the region's technology economy. Number 3, office leasing continues improving, but workplace utilization is still lagging. San Francisco recorded one of its strongest quarters for leasing activity earlier this year, with AI and technology tenants continuing to drive a meaningful share of demand. That is a real improvement, however, office attendance data still tells a more cautious story. Castle's recent data from May showed San Francisco peak office occupancy around 55% compared with the 10-city peak average above 65%. That gap matters as it suggests that companies may be leasing space again, but the way people use that space has permanently changed. For owners, this means that beyond just signing leases, the office recovery is really about creating buildings, locations, and experiences that justify why people should come in. Number 4, multifamily continues to be supported by the ownership affordability gap. Nationally, CBRE recorded that multifamily vacancy declined to 4.8% in the first quarter of 2026 as demand outpaced new supply. Locally, Bay Area renter demand remains supported by a simple but powerful reality: owning a home is still out of reach for many households. Even when buyers return to the market, high prices, elevated mortgage rates, and limited inventory continue pushing many people toward renting. While this does not necessarily mean every apartment asset is performing